Thanks, Tom, and thanks everyone for joining me today for the second quarter fixed income funds review. We're going to plow through this because we have a couple more presentations to deliver as well. So first off, this is what the various tenors within the yield curve, how they performed over the quarter. This is what traders would call a very bull flattening trade during the quarter. Most of Q2 looked a lot like a very great time to be in bonds. The bid was pretty strong. This reversed the rate sell-off that we saw in the first quarter. So I think for those who were bullish on bonds before, they finally got their day this quarter. However, the short end was largely unchanged. You can look at the bottom here, the 3-month, the 1-year, the 2-year. Not a whole lot of movement here. I think actually the 2-year creeped up by just a fraction of a basis point or so. But this is not unexpected at the short end because the Fed funds has designed to keep the Fed funds rate unchanged through 2014, so no news there, and it doesn't look like they're going to revise that anytime soon. So traders didn't have a whole lot of information to work with at the short end. Most of the movement, most of the activity, the headlines were all focused at the 30-year, the 10-year, and so forth. In fact, it was the 10-year that crossed a 66-year-old record. They broke through a yield that had not been seen in this country since 1946. The 30-year also, at its trough, had touch points that we hadn't seen since the Lehman crisis. So there you are, at the beginning of June or so, with the 30-year touching 2.5%, which is an unbelievable figure. It wasn't long ago that we thought that the 10-year at 2.5% seemed like an untouchable figure. So even lacking the crisis in banking in the U.S., we still felt compelled as investors to bid the 10-year and the 30-year very, very low to multi-generational lows. The next slide we're going to take a look at here is the activity on the yield curve. Again, at the short end, not much changed. As we work further out, we can see that the yield curve at the end of June strongly resembles where it was at the end of December of last year. Both of those figures are also well below where they were at December 2010 when things started to look a little better. We thought we were turning the corner. And we did see some good activity in the stock market in 2011 at the beginning. That tapered off. We saw a similar phenomenon this year, Q1, where equities were up and fixed income was down. That all reversed in the second quarter. Hence, we're kind of back to where we started from 6 months ago. So in some respects, the yield curve here is telling us that it was the progress we had at the beginning of the year was illusory, or how do you say it? It was an illusion? Anyway, I'll learn that word for next time. The next slide we're going to take a look at is kind of the who did what. We're going to go through just a couple of these and not highlight every single one. The first one we're going to look at is TIPS funds. This is highlighted at the top here in blue. TIPS funds did pretty well this quarter. They were up about 2.33%. So in the intermediate government treasury area, they were clear leaders. The funny thing about this group, and we'll take a look at this on the next slide, is the yield on the 10-year TIPS. This is at the constant maturity on the run. And the red line that you see here down near the bottom of it is a 0% yield. So what we have here are treasuries selling at auction at a negative yield. People are giving money to the government to keep it safe for them. So TIPS have been in this negative yield phenomenon for a number of months now. They started to work their way towards zero at the end of the first quarter, but that all was given up in the second quarter. This indicates a desire for credit protection and inflation protection, or a fear of inflation. Certainly we haven't seen a whole lot of inflation so far this year. In fact, inflation in May clocked in at about 1.7% year over year. That's the lowest year-over-year rate since January 2011. It's also the fourth consecutive month that we've seen inflation numbers print lower. So we're getting, now I'm not going to say deflationary, but certainly the pace of inflation has been slowing considerably this year as the economy seems to be crawling along or limping, whatever adjective you want to use. Going back to tips, we would also look at the rest of the market and see that all safe assets really are richly priced. It's not just tips. All treasuries have been priced to not disaster quite yet, but it certainly feels that way when you look at their yields compared to historic averages. This is again a very low interest rate environment. We would expect to see that bonds are going to rally during that time anyway. They're continuing to rally in spite of the very, very low interest rates that investors are receiving. As a further example of the interest that investors have in safety, the bid to cover at these government auctions of tips, which is a measure of the demand intensity, was about 3 in May's 10-year auction. So a bid to cover about 3. That's above historical averages. It's the highest since April of 2010. Whether you are a direct bidder or an indirect bidder, people are highly interested in Treasury products right now. And even though they gave up some ground in June for the quarter, it was an excellent time to be in Treasuries. And this is just one view, and we're looking at tips right here. The next group we're going to look at is the corporate debt area. And here we've highlighted the triple Bs, the A-rated, as well as the high yield, and these are popular groups, especially high yield. You're going to find A-rated and triple B paper as well as other qualities throughout the corporate spectrum. You're going to find it in general bonds and intermediate investment grade, short investment grade. We're not going to go into those though. We're going to focus on these three. And the activity in this quarter, if we look at the next slide here, this is the Bank of America Merrill Lynch AAA, Triple B, and Triple C total return indexes on corporate debt. And what was really in favor this quarter, following along with that flight to safety, was AAA corporate paper. It outperformed the other flavors out here. High yield had a very lumpy quarter as far as performance goes. There was a time near the beginning of May where all three were kind of knotted together if we're indexing their performance back to the end of March, where everything was kind of converging together again. And then the news out of Europe seemed a bit more dire. We had the election results in Greece seemed to indicate that they were going to abide by the austerity measures, and then there were pronouncements by other politicians saying, well, that doesn't mean we have to stay with this just because a number of voters indicated they wanted a conservative party in leadership. So as a result, things kind of fell apart again in the high yield market, and then it's kind of bounced back. It really clawed back a lot of losses in June. In fact, high yield funds in June were one of the better performers. They were up about 1.85%, which was a pretty good showing. There were some better ones, and we'll get into that detail later. But along the way, throughout the quarter, the high yield spread widened from about 600 basis points over comparable treasuries to as steep as 720 basis points, and that's where we're at the beginning of June. You can see where things had really dropped out of the market, and this is on a total return basis on the chart. And then throughout the rest of June, it clawed back another 60 or so basis points of spread to end at about 640. So, yeah, all in all, for as far as this return pattern, I think high yield was rather lucky to get back where it did. We can see that the total return performance of the AAA and the Triple B paper was also positive for the quarter. They really didn't give up any ground in June. Just goes to show you how much demand there is for higher quality paper. we're just kind of pulling in investors at the margins, I think, on the high yield side. Not a whole lot of new high yield investors anyway. The high yield issuance, according to Thomson Reuters LPC, has dropped about 50% in Q2 from Q1. So companies were sort of shut out of the high yield market. I think they looked at what was going on in April and May and decided to wait things out a bit because those spreads did widen quite a bit. The next group we're going to take a look at is on the international side. So here we're going to look at international income and emerging market debt, and a little bit more than that. But you can kind of see how, as far as world income goes, not much good news in this quarter. International income was barely positive, emerging market debt barely negative, and I'll tell you more about emerging market debt in a moment. The reason for that, of course, can be pointed out below. Currency funds were down over 2% for the quarter. Tom showed a lot of detail about how the U.S. dollar fared against its trading partners, most notably in Europe, where it was up about 6% against the euro. Of course, when the dollar is strong against its trading partners, major trading partners, that reflects or is translated into negative performance, a drag on performance, if you will, for U.S. investors. So what I found interesting about this quarter is the return of global bonds. So what we have here is the performance of various bonds, and this is in the first half of 2012. So it's not for the quarter, but actually for the 6-month period. What's interesting here is we can see a lot of sovereign debt has rallied from what some pundits have called multi-century lows. Notably, Portugal has done a great job this year of bouncing back. We also see a couple of other countries whose debt was on the ropes for a while, and Ireland and Hungary, of course, have both been in the news for their own problems. So, so far this year, some countries have seen their fortunes turn around just a bit. At the bottom end is where the real news has been made, where Greek debt has really sold off, Spanish debt as well. For the month, we actually saw Greece, Spain, and Italy sell off, although Italy was just slightly negative. For the year, though, Italian debt is actually up about 12%, so that's kind of a carryover from first quarter when Italian debt really rallied. As Tom pointed out, the Chinese Central Bank did cut its interest rate. I think this is a sign of slowing in the Middle Kingdom, and then we'll be watching closely to see what happens with the Chinese economy over the third quarter, if things are indeed slowing, or if this is just the little goose that the economy needed to start moving faster again. Like equities, overseas strategies prevailed in June. Emerging market debt funds, as I mentioned before, turned out to be the best performer of June. They were up about 3.76%. So there's definitely a burgeoning interest in overseas as the quarter ended. However, we can't be sure that that's going to sustain over the third quarter. We've seen kind of a lumpy ride so far this year as investors try to get ahead of the market. As soon as they feel like they're confident, then people start to pull back. So it's been a difficult ride for not only equity managers but fixed income managers as well. Finally, my own thoughts. I don't think that we've heard the last from Greece. It's kind of been put to bed for a little while, but it's not going to sleep. Now, can European leaders keep it together? As Tom mentioned, that summit seemed to indicate some level of success in getting people on board with a couple of ideas, but they're only ideas right now, and it's still going to be a matter of proving it to the market whether they can actually hold this monetary system together through political means. And the slowing economy stateside. I like this chart right here from St. Louis Fed. This is real retail and food services sales. If you look to the far right here on the blue line, you can see that as far as the this economic activity goes, we're still kind of touching areas last felt in 2007. So in some ways, we've had a lost half decade where a lot of the sales that feed the services sector, retail and food, are really lagging. They're still not progressing as well as some other areas. Housing is really showing some good signs of jumping back. However, housing is also a very small portion of GDP. This is a much larger piece of GDP, and it is still trying to get back to where it was before the recession of a few years ago. So a lot of progress still ahead for the U.S. economy. I still think that it's a good time to be in bonds. I don't see a whole lot of hay being made on the equity side, as Tom pointed out. A lot of negative earnings announcements, pre-announcements being made. I'm not going to be surprised to see a lot of the punditry focus on the negative side of corporate profits in the quarter ahead. So that will conclude my remarks, and I will pass this over to Matt Lemieux.